You probably think Warren Buffett got rich by picking winning stocks. He didn't, not really. That's the story everyone tells. It's the easy story, but the real one is stranger, and once you understand it, you'll never look at wealth the same way again. Here's the actual rule that built one of the largest fortunes in history. It has almost nothing to do with stock picking. In 1967, a struggling New England textile company called Berkshire Hathaway did something odd. It bought an insurance company, not a hot startup, not a trendy stock, an insurance company that wrote policies for truckers and taxi fleets. Most people ignored the deal completely. Buffett saw something nobody else did. Here's the reframe. Insurance companies collect money today and pay claims later, sometimes years later. In the meantime, that money just sits there. It belongs in a legal sense to future claimants. But until a claim comes in, the insurer gets to use it, invest it, grow it. This pool of cash has a name in finance. It's called float. Think of float like a loan that never charges interest and sometimes even pays you to take it. Imagine your landlord handing you $100,000, telling you to invest it however you want and only asking for small pieces of it back over the next 20 years. Would you take that deal? Buffett took it and he never stopped. By the early 1970s, Berkshire's float was around $39 million. Small money, relatively speaking, but it was money Buffett could deploy immediately, without asking permission from a bank, without diluting shareholders, without waiting for a good year in the stock market. He used it to buy pieces of companies he actually understood. Real businesses, real cash flow. Here's where most people misunderstand what happened next. They assume Buffett just got lucky picking Coca-Cola or American Express. He didn't avoid risk by guessing correctly more often than everyone else. He avoided risk by changing the entire structure of how he invested. While hedge funds and private equity firms were borrowing money at interest rates of 7% or more, Buffett was investing capital that barely cost him anything at all. Why does that matter so much? Because in investing, the thing that kills people isn't a single bad year. It's being forced to sell during a bad year. If you borrow money to invest and the market drops, your lender can force you to repay before prices recover. Buffett's float didn't work that way. Insurance claims trickle in slowly and predictably. That gave him something almost nobody else in finance had. Time is the ingredient behind nearly every compounding fortune in history. Ask any economist about the power of compound growth and they'll tell you the same thing. It's not about big returns in a single year. It's about steady returns left alone for decades. Buffett has said his ideal holding period for a stock is forever. That's not a slogan, it's math. A modest 7% annual return compounded for 50 years turns a small sum into a number that looks like a typo. By 2020, Berkshire's insurance float had grown past $160 billion. Let that sink in for a second. That's not money Buffett borrowed. That's not money he raised from investors expecting a payout next quarter. That's money he was essentially handed, for free, decade after decade, to invest however he saw fit. Here's the twist almost nobody talks about. Float alone doesn't make you rich. Plenty of insurance companies hold float and go bankrupt anyway. What made Buffett different is what economists call underwriting discipline. He refused to write insurance policies just to grow the pile of float if the pricing didn't make sense. Most insurers lose money on the actual insurance part of their business and hope investment gains cover the gap. Buffett insisted on profitable underwriting first. The float was the bonus on top, not an excuse to take reckless risk. This is the part where the story becomes personal, because the same principle applies to your own money, just at a much smaller scale. Most people think building wealth means finding one brilliant investment. The real skill is building a structure where your money works for a long time without being disturbed. A retirement account you don't touch for 30 years behaves a little like Buffett's float. It's capital nobody can force you to withdraw at the worst possible moment. Compare that to a habit millions of people have without realizing the cost. Carrying a balance on a credit card at 20% interest is functionally the opposite of float. Instead of getting free money to invest, you're paying someone else for the privilege of spending your future income today. Behavioral economists have studied this gap for decades, and the finding is consistent. People who carry high-interest debt while also holding low-interest savings are quietly losing money, sometimes for years, without ever running the numbers. So what does patience actually look like in practice? During the 2008 financial crisis, banks were desperate for capital and terrified of collapse. Most investors were paralyzed, selling at the worst possible time. Buffett did the opposite. He had liquidity sitting ready, some of it built from decades of float, and he negotiated favorable deals to inject capital into Goldman Sachs and Bank of America, on terms that most ordinary investors could never access. He wasn't smarter than everyone else in that moment. He was simply prepared because his structure gave him options when everyone else had none. Here's the question worth sitting with. What would it mean for your own money if you built even a small version of that structure? Not an insurance company, obviously, but a pool of capital you don't touch, growing quietly, insulated from your short-term impulses. Most financial advice focuses on picking the right investment. Buffett's story suggests the bigger lever is avoiding the traps that force you to sell at the wrong time. Emergency savings exist for exactly this reason. They're not exciting. They don't compound the way stocks do. But they're what let you leave your actual investments untouched during a downturn, the same way Buffett's float let him leave his stock holdings alone during panics that wiped out less patient investors. There's a version of this lesson in something as ordinary as your paycheck. Every dollar you're forced to withdraw early from a retirement account, whether through a loan, a penalty withdrawal, or simply cashing out when you change jobs, is a small betrayal of the same principle that built Berkshire Hathaway. You're breaking your own float. Buffett didn't build his fortune predicting the next hot stock. He built a machine that gave him patient capital and the discipline not to touch it. Then he let ordinary compounding over an extraordinarily long period of time do the rest. So here's the truth. Warren Buffett didn't get rich by being the smartest person picking stocks in any given year. He got rich by engineering a source of capital nobody could take away from him, and then refusing to disturb it for half a century. Now look at your own bank balance again. It's not about finding your version of Coca-Cola. It's about building your own float, however small, and having the patience to leave it alone.